Okay, we're going to look at a question on income tax. So with income tax question, as you know, we can ask you current tax or deferred tax worksheet. So it's important that you look at the end of the question to see which one we're asking. With this one, as you can see that we're asking you to prepare for deferred tax worksheet. So with a deferred tax worksheet, what we are looking for is to look for the deferred tax position of individual assets and liabilities. So if you take a look at the balance sheet, you will see that we have a lot of assets and liabilities on there, but that doesn't mean that every single one of them will be relevant on the deferred tax worksheet. So if you remember which accounts are relevant, that's great, but just in case if you forgot, you can actually use the additional information in order to help you to identify those individual assets and liabilities. So if we take a look at the additional information, the first one, it says that the balance of allowance for doubtful debt. Allowance for doubtful debt is an account in relation to account receivable. So the first account that we need on the deferred tax worksheet would be account receivable, because we got different rules on bad debts in terms of tax and accounting. The second one is interest revenue. It says that interest revenue is accessible when the cash is received. So this is a classic cash versus accrual difference between accounting and tax. So as a result, we know that another asset that we need to include is interest receivable. Then the one after that is development costs. So with development costs, we have additional deduction for tax purposes. So you know that we also need to include development costs. Then the next one is plant and equipment. So we have a different depreciation rates for tax and accounting. So we're going to have plant and equipment. So that's all in terms of assets. So if we go further, we have accrued expense. So accrued expense is deductible when paid. So we need to include accrued expense. The next one is rent revenue. Rent revenue is accessible when the cash is received. So the relevant account is rent revenue in advance. Finally, we also got employee benefits. So it says that employee benefits are deductible when the payment is made to the employee. So the relevant account would be provision for employee benefits. So these 7 accounts of assets and liabilities are the accounts that you need to include on the deferred tax worksheet. After that, the main thing for you to do is to compare the carry amount and tax base individually, and that's not hard to do. But before we do that, let's write down all the relevant accounts on the deferred tax worksheet first. So the format of the deferred tax worksheet is given in this particular question. On the left hand side, we're going to write down all the assets and liabilities account. So starting from asset, we need to write down account receivable. We also got interest receivable. Development costs. Finally, we will have plant and equipment. So those are the relevant assets. And then after that, we also write down liabilities. So the relevant liabilities include accrued expense, rent revenue in advance, finally, we got provision for employee entitlement. I'll just write down EE, like this, employee entitlement. Okay, those are all the relevant assets and liabilities. As I said, the key objective of this worksheet is to compare the carry amount, which is an accounting amount, with tax base, which obviously is the tax carry amount. So in order to do that, we need to start from the information that is given. So remember that you are given the balance sheet, then obviously you have the carry amount. So we go back to the question. This is a deferred tax worksheet for 2017. So all the carry amount is very important. We get the carry amount from 2017. So for example, with account receivable, we need 45,000 on the worksheet. And the same apply to all the other assets and liabilities as well that you can identify. So we're going to write down those one by one on the worksheet. So carry amount would be 45,000 for account receivable, 8,400 interest receivable, 24,000 development costs, 53,000 for plant and equipment. Remember that with development costs and plant and equipment, we need to write down after accumulated amortization and also after accumulated depreciation. Also liabilities, we got 7,200 for accrued expenses, 12,000 rent revenue in advance, and then 21,000 or provision for employee entitlements. All this information, you can just get that directly from the balance sheet because this is an accounting amount. The part that you need to figure that out is the tax base. With the tax base, you need to be familiar with the rules of tax to account for those assets and liabilities. For example, in terms of account receivable, let's think about what exactly is the difference between accounting and tax. If you take a look at account receivable, there is no difference. The only difference between carry amount and tax is that under tax base, there is no bad debt because allowance for doubtful debt, they are deductible when the customer claims that bad debt, when they refuse to pay you amount of money. As a result, the tax base of allowance for doubtful debt is 0, which means that in terms of the calculation of the tax base, what you need to do is to go back to the question, and it says that the allowance for doubtful debt for 2017 was $5,000. This $5,000 is the carry amount of that doubtful debt, but we don't have anything for tax base. As a result, we need to add it back to the account receivable. So for this one, we add $5,000, 45,000 plus $5,000 of the allowance for doubtful debt. The tax base will be $50,000. So that will be the first one. The second one will be very simple because with interest receivable, based on the original question, it says that interest revenue is accessible when the cash is received. What that means is that for tax purpose, interest receivable is accounted for based on cash basis. There is no tax base for interest receivable. So when we go back to the worksheet, interest receivable will have a tax base of 0. Okay, you have a tax base of 0. Then we go on and think about development costs and plant and equipment. Once again, we need to go back to the additional information. Take a look here. You can see that development costs are deductible when paid, again, which means that when you spend money on development, you already claim the deduction in full. On top of that, you can also claim deduction of 50%, which means that with development costs, it's already fully deductible. You deduct all of them already. Remember, tax base is about how much deduction that you can still claim in the future, which under this case is 0 as well, because you claim everything already. You can't claim anything further in the future. So the tax base is also 0. Finally, under asset, let's take a look at plant and equipment. With plant and equipment, you know that the difference between accounting and tax is that they have a different rate. With the depreciation, it says that the tax depreciation rate for plant and equipment is double the rate of accounting. So what does that mean? How much are we deducting already? So what we need to do is to go to the balance sheet, take a look at the accumulated depreciation. This is the amount of accounting depreciation. Based on the additional information, it says that the tax depreciation is double of that, which means that if you already recognize $22,000 for accounting depreciation, your tax depreciation will be double of that amount. So as a result, if you go back to the worksheet and you try to work out what is the tax base of plant and equipment, you'll notice that the original cost is $75,000 and you want to minus double of $22,000, which is $44,000. As a result, the tax base for plant and equipment will be equals to $31,000. Like that. So that's how you work out the tax base of individual asset. With liabilities, it's very simple. If you remember from the lecture slide, you'll notice that tax base of a liabilities is always going to be 0. Because with tax base of a liability, the liability that we identify, every single one of them, you already claim that in cash when you incur the amount of money. If you haven't incurred the expenses, you can't claim anything. So there's no outstanding amount from the tax perspective. As a result, they're all going to be 0. There's no other alternative on that. So that's all the tax base individual assets and liabilities. After that, we're going to work out, do we have a taxable temporary difference or do we have a deductible temporary difference? If you forgot what you need to do, there's a simple trick to account for that. You can pick the first amount and think about that. With asset, the first one, the tax base is higher than the carry amount. Then you're going to think about what does that mean. For asset, tax base means the amount of future deduction. If the tax base is higher than the carry amount, it means that you can claim more tax in the future. If you can claim more tax deduction in the future, that means you are paying less tax in the future. As a result, that particular difference will become deductible temporary difference. In other words, for every single asset and liabilities, if the carry amount, if the tax base is higher than the carry amount, then you're going to have deductible temporary difference. On the other hand, when you got a tax base that is less than the carry amount, you have the complete opposite. You have a taxable temporary difference, which is what we have with the other three. For interest receivable, development costs, and also plant and equipment, every single one of them, we have carry amount that's higher than the tax base. As a result, every single one of them will have a taxable temporary difference. That's how you work out taxable or deductible temporary difference for assets. On the other hand, liabilities is the complete opposite. Again, if you forgot about what you need to do, either you can see that this is the opposite of asset, alternative, try to think about what happened with tax. Because carry amount is an accounting amount, in terms of tax, either you can claim it already or you claim that in the future. Every single one of carry amounts here, it represents a future deduction. Because, for example, when you got a $21,000 of provision for employee entitlements, it means that in the future, you are going to pay $21,000 to employees. So in future period, when you actually recognize those amounts, by paying those amounts to your employees, that will become a future deduction. As a result, every single liability will become a deductible temporary difference. So now you have worked out every single individual tax position. After that, it's going to group them together. You're going to write down the total temporary difference. So with the temporary differences, all you need to do is to add up every single amount there. It's very simple. Add up all the taxable temporary difference, add up all the deductible temporary difference to get the total. So for taxable temporary difference, we have $54,000, 400. Deductible temporary difference is $45,000, 200. And you all know that taxable temporary difference will become DTL. Deductible temporary difference will become DTA. So after that, you're going to write down the DTL and DTA. For DTL, both of them are going to multiply by 30%. So 30% of 54,400 is 16,320. In terms of DTA, 45,200, 30% of that is 13,560. And very important, for this part, what we calculate there is going to be the end balance, which means that the 16,320 and 13,560 will become the balance of the question mark there. But the question did not ask you to find the final balance. The question asked you to prepare the journal entries. And the journal entries, we need to look for the changes in DTL and DTA from last year to the current year. This is the time that you need the information from 2016 balance sheet. Because for 2016, you already have the balance of DTA and DTL. Now you also got the balances for 2017 as well. In order to prepare the journal entry, you need to compare the balance from last year to the balance of this year to see whether we have an increase in DTL, DTA or decrease of DTL and DTA. So now we are going to write down the beginning balance. The beginning balances based on 2016 balance sheet, you notice that we got 15,150 of DTL and 10,470 of DTA. What you need to do next is to compare the balances of beginning and the ending balance. And you'll notice that for these cases, both of them, we need to write down the adjustment. For both of them, there's an increase in DTL and also increase in DTA. For DTL, we have an increase of 1,170. And then with DTA, we have an increase of 3,090. Those are the two amounts that we need in order to prepare the journal entry. Okay, so with the journal entry, we have DTL, we also got DTA, both of them is increased. To complete the journal, you need a balancing account, but we will do the balancing account at the end. It's very important that you want to establish the tax position first. There's an increase in DTA, so we want to debit DTA, and the amount was 3,090 based on the deferred tax worksheet. We also want to increase DTL as well, so we credit DTL of 1,170. So this is not a balanced journal. You need a balanced journal. So you need a balancing entry. That balancing entry is income tax expense. In this particular journal, because you got more debit than credit, as a result, you need income tax expense to be on the credit side. So we're going to write down credit income tax expense. And the difference there is 1,920. And that will be the journal for deferred tax in 2017.